Hello guys, and glad to have you on board again today. We're Wednesday, which means, as we usually do, we have a look at shorter time frames, trying to figure out if there's anything new out of the weekly updates we make on the same regular basis. So the thing is that it's still the same old story when we look at fundamental indicators and sentiment indicators. Still a huge dichotomy between the crypto market and the stock market. Easy to understand. Thank you, FTX and SBF. So the thing is that we're still trying to process all of the aftermath and so on. There will be rippling effects, there will be collateral damage for sure, but looks like the market already anticipated. Remember, we have failed to rebound for months after some very intrinsically dangerous bearish catalyst throughout the summer. So it's really more like we've anticipated the worst and we actually ended up getting it. So that doesn't mean we're due for a massive 50% correction and stuff like that. That's more for dumps to think of. So we'll see all about that in terms of future perspectives when we look at the charts. In terms of economy calendar, well, there's nothing for us to talk about. And when it comes to the dumb money sentiment, well, there we have some interesting stuff. Prices have crossed over the 50% price area, when in the same time, retail traders seems to be getting more net bearish. And we can see that as well in their net positioning. They're getting more and more traders getting short exposed with rising kind of bottoms, even though we couldn't necessarily make technical analysis out of it. But we would note the same retrospective in the fact that the buyers are actually getting less and less present in the market. Basically, as prices go up, those who bought the lows and took the risks are taking profits prematurely, when obviously, as prices go up, those who are fail to get bullish are starting to get bearish too early. So in that perspective, this is the same old story. I think that what the market will do is mostly depending on what the short-term traders will do. If they sell, prices will go up. If they buy, prices will go back to the previous supports and range a bit until we shuffle the deck, and then of course they will get net short again and will go up. Okay, we'll see all about that, but it mostly, in my personal opinion, is the dumb money sentiment which will drive the short-term price action in the charts. There are some other things that we'll have to pay attention to, and specifically this, which is a massive stuff we talked about in the weekly update. This is the first time for several months, okay? This is not just something silly, stupid, or whatever. Since June of this year, so several months in a row, we've accumulated on the overnight reverse repo, and we're finally breaking that support. So it needs to be pushed forward in the future, but it is still a confident sign that we finally find some external liquidity input in the market coming from the good old Fed repo. So the thing is that basically in here we have an absolutely tremendous amount of money. Remember, this is staggering. This is $2.4 fucking trillion who are definitely not interested into getting bonds, but they're basically just getting stored out there because there's no way, there's no other way out there. Because they can't just keep that cash on the balance sheet. So in that perspective, banks are just getting into the reverse repo because they have no other choice. So now it seems to be another choice. And guess what? Of course, this other choice seems to be putting a bit of money into real bonds, not the ones that we just get and sell back again to the Fed the next day, but basically bonds. And we've seen that huge move in the 10-year yield, but specifically stocks as well. So this is exactly what we've mentioned in the previous update, that we will eventually see the more institutional trader, the smart money, getting to push the market and support it. Not because the market is bullish, but just because it's not as bearish as people thought it would. And though in that perspective, they're going to start supporting, as very likely the retail traders will start to trade against it, because bad news, whatever, we're all going to die. You know this drill, okay? In terms of Fed fundamental, nothing has changed so far. Earlier this week, we still see the longer move on monthly, weekly, and previous expirations, which basically shows the market has now officially shifted from 75 to 50 basis points, which we have confirmed already through the prices. So it looks like we have all the information. If we look at the S&P 500 and if we look at the prices on the 4-hour reference charts in here, we're definitely trading at resistant context. So like I said, we're looking for sellers, and guess who is pointing out in that direction? The retail traders. We see the same old type of signals, which is trend signal. This is the kind of signals that I would eventually consider follow if I forecasted a bearish trend, which of course is no such a thing to me. There is absolutely no risk management in the momentum anyway to trade such signals. So the only thing I can see in here is prematurely exposed bearish retail traders fighting against smart money, putting some money in out of $1 trillion stored into the repo market. So just a single few percent of this going into the stock market is already much more than what the retail bears might be selling in this market. As we've seen back then as well, we failed every time we've tried those trend trade, and if the market reverse, it will reverse out of a bearish range or whatsoever, so more neutral tainted signals if we are on the verge to make a market top. But most importantly, the recent information has been volatility. As we broke through the moving average with quite severe acceleration with the CPI numbers, despite whichever interpretation we could make out of this. Like we said, we've got the volatility out of it. And that's all that matters to me. We've gone out from the bear case after the same volatility. I think this time around is due course to get out there. I just don't know how fast we'll do. Just like I said, I think it's more a matter of what the retails are doing. If their retails are finally getting into buying, guess what? We're going to go back there after getting there. If the retailers are selling, which suggests might be the case, then the professionals will take on the reverse repo cash and they will basically keep supporting the market, flush the bears in the process, and push them straight up to the next volatility boundary. We've got that very nice channel, and you can be damn sure that we're going to be trading above that level if we want to fuck up the bears. So as long as we ride in the bottom, in the top 50% of that channel, which is just no more than the 1 hour chart context, okay? So basically, as long as prices are not closing below 50% context in my personal lecture of the market, so that means we need to close below and we need to close at the context expiration, so when it ticks up or down. So basically I have to go there and stay there, and I personally don't think the market will do such a thing. If it does, well, that's how it is. My latest call, I've been in here, so I'm still pretty safe for now. And I'll readjust if necessary. Until then, of course, I still believe that, well, we're just going to grind our way up, as long as I said, as long as we remain in this bullish outflow, this bullish upflow, well, we're just going to grind our way through the net bears exposition of retails, which as prices go up, will keep on selling and selling and selling over time. So the more they fight against the market, the more the real market makers will actually just put some money in. Okay, we've broken some cycles in here, suggesting there are very likely more upside potential than downside potential in the stock market. So it is not an appropriate time to go in, but it is not an appropriate time to go short. That's what the message is to me. When it comes to cryptocurrencies, well, there is a lot to talk about. If we have a look at Ethereum and Bitcoin's big boys, I would look at the fundamentals first, because this is still a big mess. So Ethereum, well, still ultrasound money, folks, and we're going lower and lower day by day. The other problem, more Bitcoin tainted, is the GBTC premium, which is still very bearish. We'll see if eventually we get a relief out of this, but that would be a good sign that for now, at least, we're done with this. Latest message would have been sent in April this year, so this would be really the end of a long and painful bear market for Grayscale. But in that perspective, these are the kinds of drawdowns or discounts, okay, that we can hardly justify. To my humble opinion, we've passed long before the point of no return. So there's definitely a hole in this asset. It's clearly this. So in that perspective, my model would be everyone expect now the worst case scenario, like another massive liquidation. What could be worse than FTX? Well, it sounds to me a lot like the Lehman moment, which means basically FTX was a Lehman. It goes down and then others go down, but there is kind of a saver that comes up at some point. So back then it was the government money, but I think in here there is lots of interest into getting a shitload of Bitcoin, and who else but the Grayscale has a lot of them. So that could be an opportunity, I think, for a big market maker, things like BlackRock or so, to get their hands on a nasty deep pocket of Bitcoins, of course, at a discount, because they're going to have to refill the hole that is left in the accounting. So in that perspective, I think it's definitely worth it at some points. It's just math, and we're talking about billion-dollar kinds of math. So in that perspective in here, I wouldn't be so pretentious to say I know. I just say it is, in my personal mathematics, very plausible at that given point that if for whatever reason the discount starts to go down, then that means there's a ticking time bomb over the head of whoever might be expecting this to drop to buy it at a cheaper price. So that might be the trigger event. Like if grayscale discount starts to wind down, then that would be the sign for whoever is willing to buy that thing to eventually try to trigger some kind of attack in order to put it into insolvency territory so that they can immediately buy it back with the discount. So that would be one thing. I think this is predatory stuff in here. So just raw speculation, sharing my knowledge, but I'm not necessarily putting accusations in here. But I don't think necessary insolvency from grayscale BTC would actually be a bad sign for the market. Pretty good in my personal opinion, because there are probably plenty of big buyers who are looking at buying such deep market liquidity, even if there is a hole to fill for this. The second thing would be on liquidations. As you can see, the liquidation phase seems to be over for now. So we've gone through the long liquidation, meaning that, in my humble opinion, next one is a bear one, and it is probably going to be hell of a big one. Last time we totally failed in here, though I think this time around, well, we're going to get something nasty. So we'll see all about that, because in my personal opinion, there is still another big problem to talk about. It's not grayscale Bitcoin, it's the leverage exposition of traders. Basically, futures open interest, which you see in here, are still freakingly elevated. Even though the recent liquidation and drawdowns in the market, there's still more and more gamblers, or not more gamblers, but there's still a significant amount of gamblers. I see everyone mentioning bear market, stuff like that. People are wrecked, there's no one left alive in this market. Well, look at what it looks like in terms of net exposition open interest when we're in a bear market. So in my personal opinion, if we're truly in a bear market, then we need to destroy every bit of hope. And in the process, I've always made it clear that we need to kill one exchange. I know lots of them are actually swimming fully naked and selling puts and calls or futures contracts with leverage, and they actually have not a chance to get the supply to cover their net exposition, which means, I don't know, but there is a lot more buyers than sellers in those futures contracts, which means that, in my personal opinion, the risk is to the upside, not to the downside. To explain the math behind that, it's actually quite complicated, but I'll try to make it as simple as possible. So if we look at an asset which is over leveraged, like Ethereum, for example, everyone's bullish because merge, whatever. Like I said, this is really fundamental, but if too many people short-term gamble on something, then we're just going to go the opposite way around to prove them wrong. And then eventually over time, value will express itself and we'll go back to the mean. But in the short run, remember what we've traded back then is that I had that recovery system showing that we had collateral damage on the staked ETH stuff, whatever, and we had extreme liquidation context, which means we can range across the moving average, but over time we'll go from bearish to bullish, and we'll immediately get to trade the Bollinger Band until they flatten and open again. Thing is that you clearly can see that something has diverged in here, and specifically over the course of this moment. When we broke out of this range, to me, it was full open doors to go bullish. The thing is that we've rapidly reintegrated, fucked everyone with stop losses being hunted below the previous low point, because probably a lot of people have been going long in here and putting their stop in here. So the thing is that if there are repiling bull calls, as remember, we've traded the Bollinger Bands in here, so there's probably have been quite some buyers in this nearby area. We could still go lower. I mean, I can see that there would be demand for the 1000-ish area, but in here, if we get a lot of bullish guys getting in, leveraging themselves in futures derivative contracts specifically, what's going to happen next is that the only bits of demand there is in here, meaning that this is where we try to liquidate some long, but I think most of them have already been liquidated, so I doubt we'll get much liquidation, but probably more bullish entries. On the opposite hand, here is where all the bear stop losses will be. This is where all the bears will get stopped out, liquidated. And the thing is that, on top of it, look at where the Bollinger Band is. This is probably where we're headed, at least to the opposite Bollinger Band. We're just going to zigzag in between both of them. Very illiquid zone in here, meaning that every broker who might have a significant call exposition to the market, or bullish futures contracts or whatever, much more bull contracts than sell contracts. What's going to happen? All the bears are going to go out, and remember that the easiest way to understand this is to understand the broker has to be net neutral. It takes on the bulls and the bears, it nets out the bulls and the bears, and it exposes itself for the remaining contracts. So basically, if I have, I don't know, 10,000 Bitcoin more bullish contracts than bearish, then I have to expose myself to 10,000 spot Bitcoin in order to pay the bull clients, okay? Though what happens is that most of the time, futures trading a platform with very low liquidity arbitrage their client, meaning that if for whatever reason I have that much buyers, and then the price surge, and then I had that many sellers in the back, and I was just needing to be exposed of this, and then suddenly, oh boy, a very quick illiquid market goes to the upside, meaning that suddenly all of my bears disappear. I'm supposed to be fully exposed with this for all the remaining part until my buyers get to take their profits on the table. I need to be exposed bullish in the market. Problem in here, I can be damn sure telling you that there will be not a single bit of Bitcoin available in the spot market, meaning that all of those over-leveraged derivative exchange, we're going to have to pay clients who are long and making profits, but they won't be able to score those gains because the broker itself will be illiquid. Which means if we go up right, and we're going to have to go as high as possible until we liquidate one of those fuckers, we're probably swimming naked, meaning that they will be unable to buy the spot market asset because there will be not enough available for everyone, or they just don't have the cash and they've been gambling all along. In that perspective, when the buyers will ask for their profits, and if they ask to withdraw their profits out of exchange, because that's the current motive, by the way, well, here you got another liquidation crunch. But the thing is that this one isn't nearly bearish for prices. It has absolutely no impact. If you liquidate a futures trader, well, absolutely nothing to do with the real market. It's just probably going to be that the remaining gains that can be scored at a nice discount is going to be, we're going to take whichever thing is left in the exchange and we'll give it to clients. So that's really what this is all about, folks. If we have a liquidation event, it could actually be bullish for prices, even though we turn down another index fund, or probably, like I said, it's going to be a future in my personal opinion. So current risks stands in crypto, I think particularly for Ethereum's volatility. I know my indicator so well to tell you that if we cross over the moving average once again, it's going to be a volatility alert triggered once again, pretty much the same one as the one we've seen earlier for the S&P 500. So I would say the S&P has sent a message. The rest of the market has gone in the opposite direction because of FTX and so on. But I still see some pockets of risks in the crypto market, but not the types of risks that gets us to panic sell the market once again. More likely the kind of risks who just settles the score and put us right in the opposite direction of the range, which means after trying to liquidate to the bottom, we're going to liquidate to the top, and then nothing will happen. Remember that. I have to put things into context. Yes, FTX is a massive shock, like massive, and it fucked up many trader strategies, mine included. But the thing is that the aftermath of it might be complex, might be bearish for the market, but look at where we are. It's like we've anticipated the worst case scenario. Now that it's there, what's left to take? I personally don't think there's that much downside potential on assets like Ethereum. Of course, I could be wrong. Like I said, I can see the volatility boundaries on the higher time frame, which everyone is talking about, the 700 and the like. Yes, I know the market sometimes will go to these volatility boundaries just because it feels like it had to. But the thing is that, remember that we're in a bull trend, folks. So buying below supports because there's a volatility boundary, that's a risky bet. I wish you're going to get it if you're still among those who think we're going to get there anyway and just have to be patient and wait for the shit to happen. I personally think that these guys waiting for the 700 are exactly the same that we're going to have to buy at 200 and 2,500 if they end up being proven wrong. And in my humble opinion, the delta simply doesn't worth the risk taking. So I've said it all over again, and I'll say it again. If you invest in cryptocurrencies for the value, there's no point waiting for $700. Just buy now and hold for a long time. It's just really that simple. Put the money that you're willing to lose. It's not a financial advice. It's just pure simple mathematics. If you buy on those longer time frames, the stop loss is at 0. So fuck, folks. What the hell is going on with the futures contract trading? Don't ever gamble out there. I said it multiple times, but I hope you've listened so far. Some of those exchangers are definitely swimming naked and they're going to be taken down. though it's a matter of time, and it's not necessarily that bearish for prices. It just requires volatility, and volatility can really hit both ways. Though, with all those warnings, I hope you've listened that time around. If you still have money in illiquid futures exchanges, fuck, folks, take that down and take it out. Okay, you'd rather like to save some money on a failed trade rather than holding it just in case it goes positive, whichever in the end might just end up you losing the money, even if you were right. So really, to be honest, it doesn't worth it. That being said, see you guys later. Bye-bye.